What if I told you the biggest one-day crash in silver's history wasn't actually a crash at all, but a controlled demolition? January 30th, 2026. Silver drops 26% in a single day. Some exchanges saw it fall 35% intraday. $7 trillion evaporated from the gold and silver markets combined. The headlines screamed bubble burst and speculative mania. But here's what nobody's asking. If this was really just retail traders getting greedy, why did it take a coordinated margin hike from the CME to pop it? I've been pulling apart the data for the past week, and the story we're being fed doesn't match the mechanics of what actually happened. Let me walk you through this. Silver hit $121.30 an ounce on January 29th. That's an all-time record, not adjusted for inflation, actual nominal high. And yeah, that sounds insane until you realize silver has been in a structural supply deficit for 5 consecutive years. We're talking about 820 million ounces of cumulative shortage. That's roughly equal to an entire year of global mine production, just gone. The Silver Institute's data shows this clearly, but most analysts gloss over it because it doesn't fit the irrational exuberance narrative. Here's where it gets interesting. Throughout 2025, something weird was happening in the COMEX and London vaults. Registered silver, the stuff that's actually available for delivery, was steadily draining. Industrial users weren't trusting paper contracts anymore. Solar companies, AI manufacturers, electric vehicle producers, they wanted physical metal in their warehouses, not a promise on a screen. In early January, traders pulled 26% of COMEX inventory in a single week. Think about that. A quarter of the available supply yanked out in 7 days. That's not speculation. That's panic buying from people who actually need the stuff to make products. Now let's talk about what happened in London, because this is where the paper versus physical story really breaks down. Lease rates spiked to 8%. For context, that's the rate banks charge to borrow physical silver for short-term delivery. When that number jumps that high, it means one thing. There's not enough actual metal to go around. The paper market, futures contracts, ETFs, all those financial instruments that are supposed to track the price of silver, they started losing their connection to physical reality. Goldman Sachs published an analysis that barely got any attention. They noted that because London inventories were so depleted, price sensitivity had gone completely haywire. Historically, a 1,000-ton flow of demand would move prices by about 2%. Now, that same flow was moving prices by 7%. The market had lost its shock absorbers. So we've got industrial users hoarding physical metal, vaults running dry, and prices becoming hypersensitive to any supply movement. That's the setup. Now here's the trigger. January 30th. The CME, that's the Chicago Mercantile Exchange, where silver futures are traded. They hiked margin requirements by nearly 20%. Margin is basically the collateral you need to hold a futures position. When they raise it, traders who are leveraged suddenly need to come up with more cash or close their positions. And guess what happens when everyone tries to exit at once? Liquidation cascade. But here's the part that bothers me. The CME doesn't just randomly decide to hike margins. They do it when they think the market is getting too hot, sure. But they also do it when they're worried about systemic risk. What's systemic risk? Well, if you're a bullion bank that sold a bunch of paper silver contracts, and suddenly everyone wants physical delivery, you've got a problem. You need to either find the physical metal, which doesn't exist in sufficient quantity, or you need to crash the price so people stop asking for delivery. I'm not saying there's a conspiracy here. I'm saying the incentives line up in a way that's awfully convenient. And then there's the Kevin Warsh factor. He got nominated as Federal Reserve Chair right around this time, and markets interpreted that as a signal for higher for longer interest rates. The dollar index jumped above 97. Non-yielding assets like silver took an immediate hit. That's Economics 101. When the dollar strengthens and rates stay high, commodities get crushed. But wait, if this was really just about Fed policy and overleveraged speculators, why did silver rebound 12% within days? As of February 4th, we're sitting at $90.29 an ounce. That's not a return to normalcy. That's still more than double where silver was trading just a year ago. The mainstream story wants you to believe this was Chinese retail traders getting wiped out. And yeah, there's truth to that. Chinese speculators were absolutely a huge part of the run-up to $120. They were hedging against local currency weakness, and when margin calls hit, they got obliterated. Let me give you an analogy. Imagine you're playing Jenga, but instead of a stable tower, half the blocks are already missing before the game even starts. That's the silver market. The structural deficit, the inventory depletion, the industrial demand, those are the missing blocks. The Chinese retail traders weren't building the tower. They were just the ones who happened to pull the piece that made it wobble. The CME margin hike was the person who flipped the table. Do we really believe that's a coincidence? Here's another angle nobody's talking about. Industrial end users like Tesla, Samsung, and First Solar are incentivized to see lower prices. At $120 an ounce, they're actively looking for substitutes. The solar industry, which is the single largest consumer of silver, started thrifting, reducing the amount of silver per panel. Some manufacturers are exploring copper alternatives. That's rational behavior when your input costs go parabolic. But here's the catch. The supply deficit exists because industrial demand has been exceeding mine production for years. If prices stay high enough, long enough, manufacturers find substitutes, demand drops, and the deficit closes. But if prices crash too fast, industrial users get spooked and start hoarding again, which tightens supply further. It's a feedback loop that nobody has a good answer for. And then there's China's export controls. New restrictions in 2026 on silver shipments have essentially fragmented the global market. You can't arbitrage price differences between Shanghai and London anymore. That means regional supply shocks can't be smoothed out the way they used to be. The market has become balkanized. I spent hours trying to verify COMEX inventory numbers, and here's what I found. There's a significant dispute over whether registered silver actually exists as unencumbered bars or if it's being double counted across multiple owners. That's not a fringe conspiracy theory. That's a legitimate question analysts are asking. If the physical metal isn't really there, and the entire paper market is built on a fiction. Now let's steelman the opposing view, because that's the only way to be honest about this. Citigroup and Bank of America analysts argue that $120 wasn't a bubble. It was a price discovery event. They're saying silver has fundamentally changed from being just a precious metal to being a strategic technology metal, like lithium or cobalt. Solar, EVs, AI data centers, these industries aren't going away. Their models show a $150 price target by mid-2026. They view the crash as a healthy cleansing of weak hands. That's a coherent argument. And if you believe that structural deficits and industrial demand are the dominant forces, then yeah, the crash looks like a temporary shakeout before prices resume their climb. But here's my problem with that view. It assumes the financial system will allow silver to reach $150 without intervening. And we just saw what happened at $121. The moment the physical delivery pressure got too intense, the system hit the brakes. Hard. Robert Kiyosaki and the hard asset crowd have a different take. They're arguing this is about currency debasement, that the rebound to $90 proves the floor has permanently shifted higher because the dollar is dying. I'm skeptical of that framing, but I can't dismiss it entirely. When you look at the long-term debt trajectory of the U.S., the money supply expansion, and the fact that real yields are still historically low despite rate hikes, there's a case to be made that we're in a slow-motion currency crisis. Think about that for a second. What if both narratives are partly true? What if silver is genuinely scarce and the financial system is structurally incapable of allowing it to trade at its true clearing price? Here's where it gets uncomfortable. If the supply deficit is real and industrial demand keeps growing, something has to give. Either prices go up until demand destruction kicks in, or we get periodic interventions to keep prices manageable. What we saw on January 30th might not be a one-off event. It might be the new normal. Goldman Sachs's liquidity analysis is basically saying the market has lost its ability to absorb big flows without massive price swings. That's not a stable system. That's a system that's one bad trade away from another flash crash or another flash spike. And here's the geopolitical layer nobody wants to touch. China controls a significant chunk of global silver refining capacity. They've got export restrictions in place. If tensions escalate, say something happens in the Arabian Sea or Taiwan, China could weaponize silver exports the same way they've threatened to weaponize rare earths. At that point, the price isn't about supply and demand fundamentals. It's about national security. I'm not predicting that happens. I'm saying the market is now operating in a world where that's a plausible scenario. And futures contracts don't price that risk properly because they can't. How do you hedge against a geopolitical fracture of the global silver market? You can't. So, what happens next? Here's my read. We're in a regime where silver trades in violent, unpredictable swings between $70 and $130. The structural deficit is real, so the baseline keeps drifting higher. But every time we approach the upper bound, the financial system finds a way to knock it back down, whether through margin hikes, jawboning from central banks, or just coordinated selling from institutions that need to manage risk. The Chinese retail traders are gone. They got wiped out. That removes one source of volatility, but it also removes a source of liquidity. Thinner markets mean bigger swings. And if industrial users start pulling physical again, we could see another squeeze before the year is out. Watch the COMEX registered inventory numbers. If they start dropping below 40 million ounces, that's your canary in the coal mine. Watch lease rates in London. If they spike above 10%, we're back in crisis territory. And watch Chinese policy. If they loosen export controls even slightly, that could flood the market and crash prices. If they tighten them, we could see $150 by summer. The mainstream story wants this to be about greed and speculation. It's simpler that way. Retail traders got too greedy, the bubble popped, everyone learned their lesson, move on. But the data tells a different story. It tells a story of a market that's running on fumes, where the paper price and the physical reality are diverging, and where the financial system has to step in periodically to prevent the whole thing from breaking. You don't get a 35% intraday drawdown in a healthy market. You don't get 8% lease rates in a well-supplied market. And you don't rebound 12% in 4 days unless the underlying demand is still there. So here's the question I'm leaving you with. If the crash was engineered to prevent a delivery crisis, and the rebound proves demand is still strong, how long can they keep the lid on? Because eventually, either the deficit closes through demand destruction, substitution, or new supply, or the system breaks. And right now, I'm not seeing any evidence the deficit is closing.